Well, what does my timing model say? It's getting scary. It's saying that time is running out and we are at the end of the road. Now, I'm in a real estate asset class. It seems to parallel a lot of the other asset classes too. We're not correlated very much. But, real estate's only correlated 8 or 9% to the equity market. Certainly affected by the economy, though. We're economically sensitive, interest rate sensitive. And my model has been telling me that we have a time frame that we are going to be in jeopardy, and it is right now. And my model is a little scary. I developed this model. It's all around the world. Everyone uses the same type of model. We all have little variations of it. I'm not going to bore you with the actual calculations, but they're there. So let me go to my very first slide. Let's talk about what we have. And let's just take a look at it. Now, this is called the everything bubble, and everything bubble for a reason. If only someone could have figured out that if you put trillions and trillions and trillions of dollars into the economy in 6, 9, or 12 months, where you just flood the economy with liquidity, that you're going to stimulate inflation. Who would have thought that that would happen? Oh my gosh, if only someone would have known. And they knew that. They knew exactly what was going to happen to it. Look at these charts. We get one bubble, two bubble, and now the everything bubble. And of course, it's not just real estate this time. It's also been bonds, which has already popped. Those guys are starting to have major, major problems. Equities went up. Real estate went up. And my timing model is going red. It's going into an alarm position for us. And we want to share this. So we have been on a moratorium for new money in investments since March of 22. So let me just explain some of this to you and some of my rationale behind this. Now, here's what's happened when we talk about stocks, bonds, and real estate. Now, in my asset class, real estate, the number one real estate assets in the world is China. So the Chinese don't use the stock market or the bond market much. Most of their wealth is in real estate. Now, China is in deep economic trouble. We're talking about we having debt. Oh my gosh, China's got 4 or 5 times the type of debt that we have. And of course, people don't make as much money as we have, and yet their real estate is very expensive. Now, in China, they have $50 trillion worth of existing real estate. But here's the kicker, another 20% is in inventory that's being built right now. And of course, last year you had the Evergrande problem where this huge, number one, enormous builder in China went bankrupt. It started defaulting on its debt because it couldn't pay, weren't selling anything. They couldn't build, and causes major problem. Now, if China has a real estate problem, China is going to really just enormously correct. This is their number one asset. This is where people count their wealth, is what's in real estate. Now, this is when you look at the U.S., stocks and bonds really are the number 1 and 2 holdings for most people for wealth. 48% is in $48 trillion in bonds and $47 trillion in equity. And of course, now the bonds are starting to retrace, which we've talked about, because we're talking about we're talking about the fact that interest rates go up. They'll destroy a bond portfolio, and that's what's happening. So you're seeing that is in operation. And real estate, of course, is very rate sensitive. We've had rates that were, goodness, we broke below 3% for long-term money. Now we're up over 7.25%, and that is just putting just a screeching halt on a lot of sales. Certainly makes it difficult to find investment properties. I've had a moratorium since March 2022 when we saw the first peak come in. And that's been basically on investment properties. And we're still doing 1031 exchanges because that's money that's already seasoned and in one market, just moving it from one market. If you're selling your home in Dallas and moving to Phoenix, that's okay too. We're just having a moratorium on putting new money out on new debt. So, if you're a first-time home buyer, you're a little bit at jeopardy at the moment. So we'll go through that because my timing model is telling you that that's a problem for you. And let's just talk about where we're at with that. So let me go to my very next slide. Now, this is my timing model. Now, this is a stylized version of it. It has been incredibly, incredibly accurate, telling us where we are. Both of these mid-course corrections, my model nailed within to the month, within 30 days. We knew exactly when it was, and we knew when they were going to start to go back up in value too. When the correction was over, we knew that as well. Timing model has just worked absolutely. It just has worked absolutely perfectly, no problems whatsoever. It's been kind of scary as to what it is, and now it's telling us we're at jeopardy, really, really at jeopardy. So I just want to bring this to your attention that you're well aware, because there are things that you can do for this. You're welcome to call us. And by the way, if you like our videos, and we try to bring a lot of good content and a really good advice to you. If you like our videos, we're really trying to get some to pass these 1,000 subscribers that YouTube gives us. They opens up all kinds of doors for us with YouTube. So if you like it, please subscribe. We're not going to chase you and try and sell you anything. And give us a thumbs up. Just let us know that you like this. It really helps us out. So let me go back to this timing model, because this is very, very important. We are really at the top of the timing model. Now, at these tops of the timing model, this is stylized, so I'm not showing you the actual calculations to it, because nothing goes up just in a straight line. It goes up and squiggles up and down and tells us where we're at. Well, when you get to the top, there are actually two peaks. So we have already identified the first peak, and we've talked about that ad infinitum. It was March of 2022. Well, we could just see it come in, and it has been down ever since. And I think we're forming peak number 2. So peak number 2 is the final peak. So what typically happens when you have a timing model is that the first one is the most important. That's when they have all the exuberance, they have all the momentum, everybody is buying, they can't get enough real estate, and it peaks. And then the exuberance, the air starts coming out of the bubble, it comes back down, and then it corrects back up a little bit. So here in Phoenix, we went down almost 11%. We've come back down, and we've gained back about 6, 7, or 8%. So almost back to the peak, almost, and then it rolls over. So it's the second rollover. The second peak is the devastating one. That's one that's most destructive, and I think we're really heading into that right now. So I think you're going to see that we're pretty close to the very, very top of this peak. And that's really what concerns me right now. And then you have a fairly steep decline following. Now, this has just been time after time after time after time. Don't ask me, how it works. It just does work. And it's just, when I interview Dr. Nenner always says, I don't know why, I just know what. And our what is telling us that shortly we're going to have this completion part of the cycle. And it can be fairly destructive. So let me go to my next slide, and let's just talk about what's going on. Now, the reason I say this is because we have I think this is the second and last peak forming. Now, this is coming out of existing homes. It is seasonally adjusted. Seasonally adjusted is always a little bit of a concern, because it doesn't, what's the adjustment? However, it is showing that second peak. You can see where we stabilized and we're coming back down. So you can see where we peaked and we're coming back down here. And these are existing home sales month over month. And we came back up. And I think this is the second peak that we are looking at here. And that'll be the final one. And if that is the final one, then we are probably in trouble. Now, one of the reasons I talk about that is that, Robert Schiller came out in the last few days here and had an interview on CNBC. Robert Schiller is brilliant. He's a brilliant guy. He's one of the founders of the Case-Shiller Index. And these are his words. I would extrapolate the downturn somewhat. It's going to continue. Maybe if you have a good chance to delay your purchase, it might be a good time to do that. Home prices are very, very high by historical standards. I couldn't agree more. I think that we are coming to a point where, we're going to be fully valued. And if we're fully valued, and I think we've peaked, I think we're going into the second peak, then the next part of the phase of the completion of the cycle is going to be a tough one. So you need to be aware of it. We have strategies for that. We can protect portfolios. When we have, I represent a lot of properties. We have a lot of properties, and we talk to each individual of our investors, and there's ways we can protect this. So as long as you're aware of what's going on, we want you to know we're here to help. If we can help, we certainly will. So let me go to my next slide. And this is just showing the data to it. It is pretty amazing. Now, the reporting went on a seasonally adjusted one. These adjustments are sometimes, they kind of throw things off. So we kind of like looking at the non-adjusted. When you say have a seasonally, they're using a model. The non-adjusted is a lot easier for us to see. And last month, it actually declined, and that's the first decline. True decline. Now we've had the rate of change dropping, so the appreciation rate has been steadily falling since March of 2022. So, the appreciation rate has been coming down and down and down. Now we actually went negative in March. So keep in mind these are like 60 days behind. There's a lag by getting this. So in March we went down over 1%, so 1.15%. So that's that's 13-14% negative. That's annualized, so that can be fairly severe in places. And again, I've tried to make you aware of this, that it's regional. So some regions are going to be much more affected by others. So Florida, Texas, and Arizona are certainly going to be affected, but nowhere near as our endangered cities models. I mean, these endangered cities that we're looking at, these could take a severe beating. And of course, if you take a severe beating in Chicago, where are you going to go? Florida, Texas, or Arizona? You're probably not going to Milwaukee or St. Louis or San Francisco. And San Francisco is just taking a beating. If you look at some of my other videos, I would strongly advise you to look at some of them talking about the vacant office buildings. It's just truly amazing what's going on with that. So we've got a lot of negatives to it. Again, this is part of the why. We're just telling you what my timing model is saying, that we're very close to a rollover. High interest rates. We've got problems with social and we have an antagonistic regional governments. We also have the highest income requirement ever. So the price to median income ratio is the highest we've ever been. Now, so when you get to a historical high, that means it's never been there before, which is it's a red flag in itself. So here we are at the highest peak that we've ever had. So I'm going to tell you, you need to really be careful. Now, I'm not saying don't buy, just be sure that you are, cognizant of what you're looking at. Now, this is coming from the demand destruction, and we've talked about this over and over again. I'm telling you that we could see this come out this would be an April number, but I'll tell you, we just got this 2-3 weeks ago. I mentioned this in other videos, but when the PPI starts to collapse, you're going to have to know that inflation is going to collapse with this, and prices are going to collapse. We're going to have some deflation coming. Now, I don't know how long that's going to last, but this at the moment, we have got a steady decline of the PPI. And if you recall, in November of 20, inflation was running like at 2%. And I told you that I could see inflation coming into the pipeline in the PPI. Now I'm telling you that inflation is coming out of the pipeline, and the PPI is actually collapsing. This can be a good thing. Can also be a bad thing. It's signaling that things are really, really slowing, that demand destruction is coming. I think it's actually coming for the wrong reason. I think it's coming because the economy is really softening up. And when you get these adjustments, we look at these employment adjustments, and literally it's just they get a number and they say, well, that can't be right, so we're going to add more job hirings, and then you find out that you get 1.5 million jobs that maybe aren't even there, and yet the government's giving these statistics like inflation. They say inflation was only 9%, but other people say no, it's running like 15-18%. So what's the truth? I think most of these models that have come out for the government are turning out to be wrong. So we just need to be very, very careful with what we're looking at here. And let me go to my next slide. But one thing for sure is liquidity is coming out of the marketplace. It is certainly working, slowing the economy down like a rock. And I'm going to tell you, this is coming from our uh, New York Fed. And we're seeing this, I've used this before, and I'm telling you right now that in 1 month, the manufacturing collapsed from a positive, 12 to a negative 31.8 in 1 month. So that's almost as bad as what we had in the great financial crisis. And it's just now starting to get going. It is just now starting to develop. So I'm thinking if it's almost as bad as it was in the great financial crisis now, this has the potential to being really, really pretty tough. So we just need to be a little careful with what we're doing out there. And again, it's going to be regional. So if you look at our endangered cities that we talked about, those are the ones in trouble. Now, again, we're looking at this liquidity pop. It's just they're taking, never before have we had a negative liquidity, never before, ever. So now we have a negative liquidity, and I mean, we've never had this before, and it's having its effect. I mean, it's going to slow the economy down to nothing and put us into recession. Could be a very, very severe recession. So we just need to prepare for that. Now, I'm going to tell you the good thing about that is that we're going to get a buying opportunity if we just hold our horses here and keep our reserves and our credit and our income intact. I think we're going to do extremely well. Now, if you're in one of these cities, you really need to talk to your advisors and find out if this is really where you belong. Because Florida, Texas, and Arizona are going to be the shining stars. Phoenix is probably one of the number one growth markets in the United States. It's the number one in-migration county in the United States. Been like that for many, many years. So I would highly recommend that be something that you look at. But if you're in Chicago, Los Angeles, San Francisco, of course, Silicon Valley, you got to get out of Silicon Valley. And just let us know. We're more than happy to help you in the way we possibly can. Now, this is where you can reach me. If you want to talk about a 1031 exchange, you want to talk about moving to Phoenix, Texas, or Florida, let us know. We're more than happy to brainstorm with you. If you're looking to purchase a property and buy an investment property, I would say, gosh, we're going to have a great opportunity very, very shortly. And when that comes, it's going to be a generational buying opportunity. So at the moment, I'm not saying don't buy. It's just that you need to be very well aware of what you're buying and what the risk might be. So we are accumulating cash. We have a lot of big cash reserves, and I highly recommend that you look really hard at doing that. You can contact us, and we're kind of putting a list together to see who wants to do business, and we'll let you know when it's time to go. So listen, it's my very, very best to you. If I can help in any way, my best. Bye bye now.